And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Three of the best in the business today to talk about the ETF business. Of course, we have Tim Seymour from Seymour Asset Management, Kim Arthur from Main Management, and Deborah Fuhr from ETF Global Insight. The ETF business, folks, it just keeps rolling on, collecting more assets under management, assets invested in ETFs and ETPs, exchange-traded products, hit a record of over $7 trillion globally at the end of August. We're north of $4 trillion here in the United States, U.S., Europe, Japan, Canada, also at records as well. Deborah, tell me, what stands out to you as the biggest ETF trend so far this year?
Hey, it's great to be here. So I think one of the biggest trends is the fact that ETFs really busted the myths that they were able to handle the significant volatility in inflows and outflows during March and April. I think from there, what we're seeing is a significant increase in the number of investors using ETFs. So we see that there's nearly 6,000 institutions that hold just about half of all the ETF assets in 62 different countries. And when we look at where the money's going, I think we can see fixed income year to date has globally taken in 160 billion of net inflows, up from 148 last year. The Fed has clearly given a good signal to people that ETFs, fixed income, high yield, and investment grade are good investments. We've also seen equities where investors are looking for themes to play post-pandemic. So that would be ESG, technology, healthcare. We're also seeing active non-transparent. We have 15 new launches this year, gathering about 500 million so far. And gold has clearly played two different views there for investors. There are 49 billion of net inflows. Some see it as a safe haven. Others see it as a potential and hedge against inflation, given all the stimulus going into the markets.
Yeah. And Kim, she brings up a very good point here, Deborah, that the volatility that we've seen has not resulted in any dramatic problems with the ETF business overall. You deal with a lot of investors. Does the fact that the ETF business again has handled a bout of volatility very well, even in bond funds, thinly traded high yield bond funds, for example, is that making institutional investors even more comfortable in using ETFs as investment platforms? Would that account for the fact that we're still seeing assets under management continue to increase?
Yeah, Bob, I would definitely agree with that. I think historically here, going back every time that we've had a volatility spike or disruption in the market for the last 20 years, ETFs have done a phenomenal job. They've done exactly what they're supposed to do with the price discovery. There's liquidity on both sides. It's not like the old days when you pick up a phone and try to call a dealer when bids were fading and the phone would just keep ringing and ringing and ringing. So they are doing exactly what they're supposed to do, and that's definitely why we are seeing institutional involvement continue to increase, like Deborah mentioned, with the 6,000 holding half of them. And high net worth individuals continue to move into them aggressively, too.
Yeah. And Deborah, just a quick comment, very quick on ESG. We keep seeing money pouring into ESG. It's really a sub-asset class by itself. And yet we've seen some pushback recently in the U.S., some people arguing that investment firms or advisors should not be pushing people into what are essentially ideological ideas. But that hasn't slowed down the money flows into ESG, has it?
It hasn't at all. And I think part of the difference is if you look at Europe, you see that the regulators are actually encouraging the asset owners, pension funds to invest along these ideas. And we are seeing that it's not just it's clean energy, it's social movement. So I think what happened with COVID, where we saw the climate really improve, we saw that social diversity matters. And we're seeing that some of it is thematic in the way people are investing. But I think the important thing is that companies that do better in terms of the way they treat their employees, in terms of governance, actually over the long run perform better. So it's not doing good to give up performance. You actually can find that these are tenets that are very important to have companies that are going to do well over the long term.
Yeah. I want to move on here because we're having another busy week for new issuances for IPOs and direct listings this week. I want to take note of that. We've got nearly a dozen new listings coming, including direct listings from Palantir, which is a data management firm, and from Asana, which is coming out this week. They're a work management platform. Kim, I'm wondering if you can comment on this. The IPO ETF is at a historic high today. It's up 68% so far year to date. It's got finally attracted 200 million in assets under management, which is a pretty nice threshold to pass. It's taken several years to do that. What's behind all of the sudden IPO rush?
Yeah, Bob, I think it's the push for where the puck is moving for leading edge technologies and disruptive technologies. Obviously, Airbnb and DoorDash. I look at my father, who's 83 years old, and he did not know what a DoorDash was before this virus, and now all of a sudden he's one of their biggest proponents. So it's clearly where the puck is going. I think what's interesting too is there's still a huge pipeline of these deals here. 491 unicorns with $1.5 trillion in aggregate market cap, so an average of $3 billion. That's a lot of deals that are teed up. And as you mentioned, these direct listings like Palantir. Yeah. One thing I will mention on Palantir is if you look back 6 years ago, Bob, when they did a round of financing that was probably at about an $8 billion range or level at that point, because it's taken them so long to come out public now, in the ensuing 6 years, there's been about 28% dilution that's happened during that time. So there's now going to be 1.9 billion shares outstanding instead of the 1.5 billion. But still, where these things are going, one other thing that I would just mention, too, is, again, you had 900 IPOs in 1999 and 2000. If we get to 170, then last year and this year combined are only about 1/3, a little over 300. Yeah. So there's still a very robust appetite, and given what's going on, there's still a lot more that can happen.
Right. Tim, let me bring you in here. We're talking about the spate of IPOs. But one thing that's quite amazing to me is how the ETF business has been able to capitalize on whatever trend is happening. We already have work from home ETFs that are out there. They seem to capture. It's a perfect vehicle for capturing the zeitgeist. You can call it whatever you want to call it. Investing by trend, if you want to. I've heard some people say that. But it really is quite amazing. And you can see how some of these names like Zoom, Moderna, Peloton, CrowdStrike, they're in a lot of these ETFs that are out there that are on disruptive technology. So they're beneficiaries of in a way, in a perverse way, of the whole COVID movement. And the ETF business has benefited from this. Again, it's rather perverse, but that seems to be the case.
Well, yeah, and it's not surprising at all that the ETF industry is able to adjust and adapt and find thematic investments and present them in an efficient way for investors. That's kind of the ethos of what's been going on. And as you look at the trends we're talking about here on the show and some of these IPOs and where they're positioned within the economy, the IPO ETF can certainly be there to look at the tailwind of IPOs overall that we're all discussing as a function of liquidity. It's a function of really markets that are reaching out and grabbing risk at a time when maybe they should or should not be, but the performance of IPOs are largely, in a very strong environment. There's been other times when they have not been, and in fact, investors need to be very careful when they're even investing in an ETF that's exposed to IPOs, where they're investing in these IPOs. A lot of these IPOs may have done great on day one or day two, but really underperformed for the next 3 to 9 months. Look at Moderna. Look at Uber. I mean, Uber's underperformed the S&P by 25% since it came to market. So investors really need to understand if they're investing in an ETF that gets exposure to the IPOs, how active is it, and really what is the strategy. But finding thematic ways, and so whether it's cloud or whether it's online and e-commerce or whether it's different types of online security, the ETF world, that is why ETFs are so popular, because it allows investors who can get thematic exposure, and this is a perfect time for that.
Yeah. And Deborah, I wonder if you get your thoughts on this. What's amazing to me is just catching that wave is there were SPAC ETFs have been announced now. We know SPACs are really big, alternative ways to go public this year. And sure enough, there was a SPAC ETF announced. We've had companies that are putting SPAC companies into their ETFs before deals are even completely consummated. So it seems like ETFs are becoming a sort of vehicle for quickly maneuvering ideas. We call them generically thematic ETFs. Do you see any overall trends happening in this besides the obvious fact we've got robotics and work from home and now SPAC ETF that's coming?
I think everyone in the ETF industry is quite innovative. So they're looking for ways to provide exposures that people want. So there's a lot of smart people who are trying to come up with new types of indices and new types of exposures. So yeah, I think you're totally right. I think right now there's a new filing. So there's 5 SPAC products that have been filed. So yeah, any opportunity to bring out a new idea that would be a theme for people to invest in is clearly where the industry is focused.
Yeah. And that SPAC ETF, the one that I talked about a couple of weeks ago, SPAK, not out yet, but it's filed but not approved. So keep an eye on that. I want to move on and talk about China. We've seen several large China fund companies launching ETFs that are going to be tied now to the Star 50 index. This is this new index that the Shanghai has got for the newest, hottest technology names, which would include Ant Financial, likely coming in October. So what's interesting about this, guys, is several China funds have announced they're going to launch these ETFs, but that appear for the moment to be only available to mainland investors, not investors outside of mainland China. And Tim, you got to think about this. This is some of the biggest tech names you never heard of. I think you used that phrase, are going to be potentially in this. And I guess the question is this good or bad that outside investors can't get in on things like potentially an Ant Financial being in one of these big ETFs? Is this good news or bad news that they're sort of restricting these ETFs initially?
Well, it's unfortunate, and I think one of the issues that China's faced with a lot of their markets and inclusion in global indices, although they're doing this, and they've been doing this with their fixed income markets, and they've been doing it with their commodities markets, but the ability to have enough liquidity, enough access, it's one of the things that China is very focused on, and it's how they continue to up their weightings in the MSCI. They know what kind of the benchmarks for them are. But as you're saying, a lot of the Star 50 is either locally listed or Shanghai or Hong Kong. And to the extent that some of these names, and Ant Financial will be listed in Hong Kong. And it does give a lot of global investors who, through whatever platform they invest through, access to Hong Kong stocks is largely prevalent. So, the point simply about the size of the opportunity for China tech and where U.S. investors should be exposed. When I say these are some of the biggest companies you've never heard of, I'm talking about NetEase or Tencent Music, which is bigger than Spotify if you look at their total audience. The sheer size, Ant Financial is going to come to market and be bigger than almost every other financial company in the world, other than, and certainly in payments, it's going to be a smaller company than Visa and MasterCard, but it won't be that far off of where JP Morgan is, and it'll be bigger than Bank of America and PayPal and all these other names. So the size of the market, the size of the opportunity, the ability to replicate trends we've seen over here, U.S. investors should stay focused on this because, arguably Tencent and Alibaba are two of the most important tech companies in the world. And there are a lot of other companies that are coming to market over there every single day, and U.S. investors should stay focused. Yeah.
I want to ask Kim your thoughts on a small topic that really caught my eye last week. Fidelity Magellan Mutual Fund is legendary. It was run by Peter Lynch up until 1990, probably one of the greatest investors of all time. But they announced they're going into an ETF format. Now, I thought this was amazing because it's going to be an active, non-transparent format because, that makes sense because they're actively managed. But like almost all funds, this Magellan Fund has notably underperformed the S&P 500 for many years. So I guess, Kim, am I trying to stress too much? This is another sign of capitulation. Here's a very, very famous fund that's basically saying we're going to go to an ETF format, although we're going to try to keep doing it in the active, non-transparent format, so we're not going to reveal exactly what we have. Am I trying to make too much of this? I just think this is another one of those capitulation moments by the mutual fund industry moving into the ETF format.
No, Bob, I would totally agree with you. This fund's been out there for 57 years, and it's definitely not the fund that it was when Peter Lynch was running it. And like you said, it's underperformed its benchmarks. And it's probably most of the underperformance is from the 77 basis point fee that it charges. But I think as Tim and Deborah have mentioned here, what's happening is if they were to come out and say, hey, we're reconstituting this and we are now going to be a thematic innovation strategy, not just growth, but we're focusing in on where the puck's going, on innovation, on great themes, then you could maybe say we're going to go ahead and give this thing a second derivative life. But to just go ahead and change the wrapper and still have the same underlying kind of benchmark growth less your costs doesn't really excite people, and probably shouldn't excite people.
I don't think it does. But Deborah, still, it is a sign. Active, non-transparent is having a moment here this year, and they are going to pull funds out of mutual funds and into the ETF format. Even if it's essentially the same thing, there will be lower costs and there will be more tax efficiency. So to that extent, it's a good story, isn't it? Or am I looking at this the wrong way?
No, I think you're totally right. I think ETFs are more tax efficient than mutual funds, and they're less expensive to run than mutual funds. So there should be some real benefits for the investors. And clearly, if the fees are less, performance gets better.
Yeah, I agree with that. Okay, guys, thank you very much. Appreciate a lot to go through here, but we get the best in the business here commenting on what's going on. And that's it for this week's ETF Edge. And my thanks to Deborah, to Tim, and to Kim here. And as always, you can see all of our videos, etfedge.cnbc.com. And don't forget our podcast at the same time, where we go into a little more in-depth commentary on the ETF trends for the week. Thanks, everybody, for joining us, and everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.